The panel this morning is focused on bank solvency, or in the discussions among the panelists, we've broadened that a bit to financial stability more generally, and monetary policy. As we all know in this room, in response to high and rising inflation, major central banks around the world raised their policy rates starting in 2022, and also reversed their balance sheet expansions to some extent. In the US, this has led to a 500 basis point increase in the policy rate and balance sheet reductions of $600 billion, or about 7% of the initial asset level. So most of the discussion has focused on the pace of tightening, and which was more rapid in the US than in Europe, and the magnitude and timing of the economic response to the policy tightening. And of course, the trade-off between inflation and unemployment. But cracks in the financial sector earlier this spring have put more focus on the potential for instability, especially after the failures of Silicon Valley Bank, Signature Bank in New York, the acquisition of First Republic Bank by JP Morgan Chase, and the collapse of Credit Suisse in Switzerland. This has caused some to ask how central banks should balance their inflation mandate against financial stability, specifically asking whether central banks should prioritize financial stability at this point, and whether that requires a change in rate and balance sheet policy, or if instead prudence requires that rate and balance sheet policy remain focused, and that other regulatory and supervisory tools, for example, such as capital payout policies and supervision, be used to address the financial stability concerns, while acknowledging that the credit channel of monetary policy, particularly in bank-dependent countries, which we'll discuss more today, would transmit higher rates through tighter bank lending in any event. These approaches have very different implications for the path of policy, the need for legislation and other implementing measures, and the risks for the economy, which may also differ across countries. So for the panel today, we're joined by Kristen Forbes, the Lemelson Professor of Management and Global Economics at MIT, and a former external member of the Monetary Policy Committee of the Bank of England. Neel Kashkari, the President of the Federal Reserve Bank of Minneapolis and a current voting member of the FOMC. And Philip Lane is a member of the Executive Board of the European Central Bank and Chief Economist since 2019, who was previously Governor of the Central Bank of Ireland. So we'll start the panel with Kristen's remarks. We'll have short remarks from each of the panelists first, then some discussion. And if we're committed to time, we'll have questions from the audience.
Okay, thank you very much. So my role as the opening speaker alphabetically, and also is the one who is not in an official policy job right now, is to provide a little background on the structure of thinking about potential tensions between monetary policy and banking solvency. So I'm going to start with a broad overview of what the issues are, the frameworks we use to think about these issues, and then bring in a few examples from the UK, and then leave it to my colleagues to give you more information about the situation for the US and the Euro area. So let me jump right in. The topic for today, maybe, is, there we go, the two worthy goals, price stability and banking solvency. These are both important. They are both interlinked. It is very hard to have price stability if you do not have solvent banks and a viable banking system. Banking system collapses. That generally causes a deep and severe recession and undermines price stability. The flip side, it's hard to achieve banking solvency when you have volatile inflation and you do not have price stability. So two important but interlinked goals. How do you achieve these goals? There's traditionally been a fairly standard division of labor where there's different tools to accomplish each of these goals. For example, solvent banks are best attained through good regulation and supervision, prudential regulation, macroprudential regulation, and if problems do emerge, usually best to address them through liquidity facilities. The flip side, to achieve price stability, the set of tools is generally interest rates. Just interest rates to achieve price stability, pretty straightforward. The one area, the tool where it's a bit of a fuzzy line is asset purchase programs. Asset purchase programs have been used to achieve both. For example, when COVID hit in March of 2020, large asset purchase programs were announced largely to stabilize financial markets, provide liquidity. So really aimed at sort of supporting the banking system and broader financial system. But then that morphed into asset purchase programs focused more on achieving macro stability, price stability, and supporting growth and employment. Hopefully going forward, we're going to see more clarity when central banks use asset purchase programs. Is it more directed at solvency of banking systems or financial systems, or more at broader price stability? But the lines have been muddied in the past. But more or less, when we're talking about achieving these goals, key role for price stability, to attain price stability, is to use interest rates, banking stability, use regulation, supervision, et cetera. Now, where the line has become fuzzy recently in what is the focus of our panel is if there's starting to be more tension of the need to raise interest rates to achieve price stability, if that could start to undermine banking stability and banking solvency. And it's this tension, which again, I think is the focus of our panel. So how could this tension arise? So what I want to do for the remainder of my comments is just go through sort of basics of bank accounting to understand why there could potentially be a tension if central banks need to continue to raise interest rates, if inflation is more persistent than expected, how that could start to undermine the solvency of banking systems. So I'm going to use an example of a stylized bank balance sheet, call it the Royal Bank of the UK, where I'll draw some of my examples. Here's, again, very simplified balance sheet of banks. Now, I think before we talk about the risks to banks from higher interest rates, it's important to start with what usually is the standard issue is that usually low interest rates are bad for banks and higher interest rates are good for banks. I think there's actually a great irony, the period when I was at the Bank of England when interest rates were quite low, banks came in constantly complaining about low rates. So now that they're complaining about high rates, it's quite a switch. But the reason why central banks usually like higher interest rates is because the bulk of bank balance sheets is loans and deposits. And when interest rates go up, banks charge more on their loans, but they also have to pay more on their deposits. But the two rates don't go up to the same degree. Usually when interest rates go up, banks charge more on their loans or increase the rate they charge on their loans by more than they pay depositors on the deposits. So that differential, the net interest margin, usually goes up when interest rates goes up, especially when you're off the lower bound. And banks can make a nice amount of revenues from this NIM, this net interest rate margin. Nice presentation by Philip Schnabel yesterday talking about this, how on average when interest rates go up about 1%, the differential is about 60%. So deposit rates go up by about 0.4, while the rate charged on loans go up by about 1%. So again, banks do well when interest rates go up. And I think that's important to keep in mind as we look at some of the hits that can happen to banks because of higher interest rates. Some of those losses in other areas of the balance sheet can be balanced by this increased revenue coming in from the net interest margins. Okay, so that's the good news for banks. Now, where's the bad news when interest rates go up? Let me just, one slide. Just for the UK, this shows the increase in net interest margins in the UK. When rates were low, the revenue they made on this differential between what they charge on what they charge or pay on deposits and charge on loans was low when rates were low. It's gone up, and banks are now making a nice revenue stream from that. Okay, so where can banks make losses as rates go up? The first area that's gotten the most attention from the runs that happen in the US are if there's a run on deposits. We all know even well-capitalized banks, a lot of equity, can go under very quickly if there's a large run. That risk has settled down. I think the bigger concern for banks now is that as interest rates go up, people and businesses are pulling deposits to put them somewhere else where they can earn a higher return. This is sort of a slow bleed we're seeing in banks around the world. We're seeing some of that in the UK. This is what's happening to household deposits in the UK. They went up quite a bit during the COVID when savings went up. Some of the drawdown we're seeing now is just people drawing down the savings they accumulated during COVID. That's the blue. But some of that money is being reallocated to other forms of savings. Some of it is still in the banking system in other forms of deposits. Some of it is going into buying gilts, the equivalent of treasury bonds. Some is going into other assets. So there's sort of a slow bleed of money coming out as depositors take money to earn a higher return. This for me seems like a manageable risk. This is traditional effective monetary tightening. As long as there's nothing that triggers a severe bank run. Again, this is part of the tightening cycle. And if deposit outflows start to accelerate because depositors want to earn a higher return, banks could pay more on the deposits. There is, especially because their profits have gone up quite a bit. So there is room to stem this sort of slow bleed if needed. Okay, so that's one risk. Turning to the asset side of the balance risk, where are other risks of higher rates? Another one that's gotten attention recently is the losses from bank holdings of government debt, gilts in the UK. We heard quite a bit about this yesterday. NBER research has highlighted some pretty scary numbers from the US. If you calculate the losses on government bond holdings in the US banking system, something around $2.2 trillion. If all of that is marked to market and realized right away, that's a big number, roughly equal to bank equity in the UK, in the US. But those losses will only be realized if the bonds are sold. If they're held and rates come down a bit, you will not have those losses. Some of those losses could be paid off over time by higher revenues. Now, it's important to realize from a cross-country perspective, those losses aren't as big in other countries. Other countries are forced to mark to market. And this is a nice graph that the OECD has put together. It estimates unrealized losses on the overall banking system in different countries from a 1% increase in interest rates. Looks like Japan also has a big problem in this area, but then Italy and the US. After that, most other countries are fairly low exposures to losses in the banking system from holdings of government bonds, in particular the UK. Is far to the right. So yes, this is something that should be watched. It should be, you should be holding some reserves against this, but especially if interest rates do start to come down, we will not fully realize all of the losses that we're hearing these large numbers about today. Okay, other risks on the asset side. The biggest area is loans. If the economy slows, we're going to see more defaults, and you're going to see defaults from households on their loans and also from non-financial companies. How big a risk is that? So there has been a lot of attention to the losses from higher interest rates on mortgages, people being unable to pay their mortgages, and that potentially leading to defaults, which could hurt banks. Not surprised there's been a lot of attention. That's where the last crisis occurred in 2008. So this is where I feel like we do have a pretty good grasp of what the risks are. Banks have been pretty good about capital hedging against this, preparing for these risks, because again, we're always good at fighting the last war. And also, I think these risks are not nearly as big today as they were in 2008, for example. Couple of reasons. First, here's the key way to assess risks around higher mortgage interest rates, putting pressure on households so they default on their mortgages. You look at debt household service ratios, or DSRs. Basically look at your ability to pay your debt relative to your income. You see these are going up a bit in the countries we're talking about today, but the debt service ratios are still quite low compared to where they have been in the past. Some countries, these risks are quite a bit bigger. For example, Sweden, Australia, Canada, that's from a combination of factors. One, those countries, people have just taken out more debt. And second, more of the debt is floating rate. So higher rates pass through more quickly. But UK and US, the risks are smaller, partly because we have more fixed rate debt. Although in the UK, it's only fixed for 2 to 5 years. So those risks will come soon, but US risks are slower. But two other reasons why I think these risks are manageable. One is, although debt service payments are going up, incomes are going up too. Incomes are going up at a solid clip. Wage growth in the UK just announced yesterday, 7% annual wage gains. That helps cover higher interest payments. The other factor, which I think hasn't gotten enough attention, is that as mortgage interest payments go up, this is data for the UK on the left, mortgage interest payments are going up. That's going to put pressure on some households, but the blue shows that households are also earning more on their savings. And even with any savings in the bank is now earning some real money. Granted, it's not the same people. People with mortgage debt aren't always the ones with savings. There could be different marginal propensities to consume. But over on the right, it shows that on net, although people are still paying on net some, they're paying less because earnings overall on savings have gone up more than the increased payments they're making on their mortgages. So again, a risk to watch. Those costs will grow as some of the refinancing of mortgages kick in, but manageable. Last one I'll talk about on the loan side, risks from defaults on loans to non-financial companies. A lot of attention to risks in the CRE market. That is a real risk. CRE market has been hurt. Commercial real estate values have gone down. Some of that is from higher rates. Some of it is from a readjustment of where people work. Cities, less people are working in cities, so that's a double hit on the CRE market. There's going to be losses there. But again, this is on the radar. Banks are calculating that and holding capital against it. And the sector of the non-financial companies I worry about more is small and medium enterprises. These are where small and medium enterprises don't have other places to go for funding other than banks. It's getting harder for them to get access to lending from banks. Default rates have gone up for SMEs. SMEs took on more debt during COVID than larger companies, and defaults have increased. They've come down some, but they're still high. And SMEs are an important source of employment. In the UK, it's about half of jobs. So if we see more challenges in this sector, this will start to bite and is something to watch. So the last one, which I will not have time to talk about, set of risks is from banks related to the non-bank financial sector, shadow banking system. I heard quite a bit about this yesterday in this room. I think these risks are so diverse. It's again hard to talk about in 1 minute, but hopefully in the panel we can talk about this. As non-bank financial sector has grown in this era of tighter regulation on banks and low interest rates. The non-bank financial sector is now shrinking, and that will involve some risks to banks that are harder to assess because it comes from some very different sectors. So to tie it all up, some final thoughts, key points to take away. Some tightening in financial conditions is necessary. It's part of the adjustment to achieve price stability. Inflation is too high in most of the world. We have to tighten financial conditions. It's going to affect banks in the broader financial system, but the impact on individual banks and bank solvency will depend on the specific exposures and financing of the individual banks. Some banks are going to gain through this process from higher interest rates. Others will not. But should all this imply that we should diverge from our standard division of labor when adjusting rates? Should we back off tightening interest rates because of concerns for banking solvency? I think that's a very high bar, and we haven't reached it yet. At least. We might in the future, but at least not yet. I think in order to sort of hold off raising interest rates to address inflation, you must have a real risk to bank solvency that is not better addressed through other channels. And at least for the UK, I don't see much tension today between price stability and bank solvency. The priority for the UK needs to be bringing inflation down. This is core inflation. Take out the temporary effects of energy, food prices. Core inflation is starting to turn around. It's still too high in advanced economies around the world, especially in the UK. It's about 7% in the UK. This does not seem the time to back off raising interest rates because of concerns about bank solvency.
And the next speaker is Neel Kashkari.
Good morning. Thank you to the organizers for inviting me. It's great to be here participating in this important conversation. Let me just give a preface that my comments reflect my own views, don't necessarily reflect others in the Federal Reserve System or the Federal Open Market Committee. This morning, just a few moments ago, I published an essay on the Minneapolis Fed's website and on Threads that goes through my comments in a lot more detail. And so I'm just going to give you a very quick summary of that here. And I look forward to the discussion with my fellow panelists and with all of you. In order to preserve anchored inflation expectations, central banks must bring inflation back down to their targets in a reasonable period of time. But price stability, and in the case of the Federal Reserve, also maximum employment, are not our only objectives that central banks must aim to achieve. As Kristen just said, ensuring financial stability is also a primary responsibility for central banks because financial crises can cause great hardship to Main Street. Now, managing inflation and financial stability are usually distinct and often complementary goals where central banks' limited policy tools can simultaneously work to support both objectives. But these goals can come into tension at times, creating a dilemma for policymakers to decide which objective to prioritize. In recent months, such a tension arose when some regional banks in the US ran into trouble due to security losses triggered by poor risk management at these firms in the context of policymakers having raised interest rates to combat high inflation. Although today, overall, the banking system is sound and resilient, bank stresses nonetheless could emerge again. In my view, given the risks that these banks have taken on, the outlook for some regional banks largely depends on what happens to inflation. Now, if inflation falls as markets currently expect, then allowing policy rates to fall, bank balance sheet pressures would likely reduce as longer-term rates fall, which would cause asset prices to climb. However, if inflation proves more entrenched than expected, policy rates might need to go higher, which could further reduce asset prices, increasing pressure on banks. In such a scenario, policymakers could be forced to choose between aggressively fighting inflation or supporting banking stability. Increasing bank resilience now could reduce the chances for such a difficult tension to emerge because banks would be positioned to handle further mark-to-market losses that would stem from higher policy rates. This would then minimize the risk that policymakers face a difficult choice between bringing inflation down and maintaining financial stability. However, the historical record shows that banks are unlikely to take meaningful action to enhance their resiliency against this risk on their own. In my essay, I walk through all of the options that banks have and how there are very few good options for banks. So bank supervisors should instead use their own existing authorities today to ensure that all banks are prepared to withstand a higher rate environment. So with that brief summary, I look forward to our discussion. Thank you.
Okay, thank you. It's a pleasure to be here. And it's, I think, a very well-timed session after, a year of policy hiking at the ECB. We know the lags in monetary policy are more than a year. So there's a lot to think about and to discuss. And over the next year or two, we will learn quite a bit. And a bit like Neil, I did put out on the ECB website a long version of what I'm about to say. I don't think Threads has been released in Europe yet. So I'm afraid you will actually have to go to the ECB website. So what I want to do is, first of all, raise a few issues about, basically, which, falls under, is this time different? What is similar and what is different between the current configuration versus historical tightening cycles? Then I'm going to sprint through a few basic charts and then offer a couple of final remarks. But again, all in the context of the more considered argument is on the longer essay. So let me point out a couple of things about, just as a reminder, in terms of the European situation. In the last year, rates have gone up by 400 basis points. And there's been a lot of shrinkage of the balance sheet. And again, to emphasize in the European context, it's quite different to here in the US, because yes, there is a roll-off of the asset portfolios, but the big reduction in the balance sheet so far has been the reduction in this targeted lending program. So there's a very large creation of central bank reserves to have a large lending program to banks during the pandemic. And that is moving down quite quickly. So the overall contraction in central bank reserves so far has been mostly driven by that. Now, what I want to emphasize is the banking channel. I mean, you can go a long way, of course, just by looking at, well, how does the economy respond to interest rates? But the policy rate, but actually the whole yield curve you need to look at. But then especially, we know the euro area is a bank-dependent region. You do have to think about the different channels. We say, okay, all of this is going to be intermediated by banks. One element of that is the balance sheet channel, which of course really is three components. One is the balance sheets of banks themselves, then the balance sheets of their corporate customers, and also their household customers. The second is the bank lending channel, in the sense of, what are the incentives to lend as opposed to hold bonds or make other decisions from a bank point of view. And then whether it's a third channel or a sub-channel of that is the risk-taking channel. And again, when we have this tightening cycle, does the attitude towards risk-taking change? So let me say that there's four categories of topics which many people are discussing in terms of, is this time similar or different? One, and again, it's true in the US, but it's definitely true in the euro area. If I go back to 2019, when I started at the ECB, the dominant conversation in Europe is Europe turning into Japan? Are we turning into chronically low inflation? The pricing, the surveys and the pricing had policy rates would be negative for a long time, and might barely get to a zero policy rate by late 2020s, which is not where we are now. So before the pandemic, that was the kind of conjecture. So essentially what's happened now is really two factors. One, there's been a permanent change in the sense of unless something new happens, no one believes we're going back to negative rates. The surveys we have in the market pricing basically says X years from now, the policy rate will be about 2, consistent with a real rate around 0. So minus 0.5 to 2 is basically priced in forever. And then on top of that, the fact we're now at 350, probably going to 375 in the next meeting, that is a, if you like, kind of cyclical tightening, which people don't believe will last forever. And then in terms of instruments, no one believes we're going to go back to large scale QE or large scale targeted lending anytime soon. So the scale of the balance sheet is going to be a lot smaller than was previously expected. So compared to late 2021, before we started turning, the expected balance sheet now is probably running $1 trillion lower in expectation, which is quite a turnaround. And then the question is, how does monetary policy work when you have not just a cyclical tightening but a long-term shift in policy? How does monetary policy work when it's not just about rates, but it's also about the basic choices facing banks and the fact this basic liquidity environment we lived in? We also have to think about the fact that the balance sheets of banks, households, and corporates look reasonably good going into this shock. The pandemic was a windfall for European corporates. Large-scale fiscal transfers helped European corporates, and European households, because of forced saving, had a kind of exogenous, if you like, improvement in balance sheets. And compared to 15 years ago, banks have a lot higher capital, have a lot higher liquidity than they did beforehand. And all of those matter, but equally, we do have to think about in all of those cases, what is the behavior behind that, as opposed to just saying, well, here's my state variable and how it moves things. And maybe I'll make the last point, which I think is quite relevant for this year. There is a difference between how a supply-driven inflation shock operates versus a demand-driven. So last year, when we had this, the year before, when we had these adverse supply shocks, we had inflation going up and basically downgrades to the economy. And both of those would be, I suppose, bad for bank decision making. Whereas this year, we have the reversal of those supply shocks. So yes, we do have interest rate hikes, but we basically do have a rising employment, as Kristen said, and rising wages. And so in the context of, if you like, the macro picture, some of those do need to be counterbalanced. Whereas if it's a reversal of a demand shock, which is maybe more in the US style, when that demand shock reverses, then the economy slows down, upward pressure on unemployment, and so on. So the interaction of the bank channel with that macro channel is relevant. Okay, so those are some open questions, but let me quickly point out a few issues here. So in terms of the funding costs facing euro area banks, you can see both in terms of the last 15 years and the last year or so, you've had this fairly sharp increase, where of course the most spectacular increase has been in if a bank wants to issue a bond, the cost to it of bond financing. The blue line is the composite change, is the balance across the different funding lines of banks. But let me emphasize is over time, that is moving because over time, many European households work out, I need to make the effort to move out of my overnight deposit into a time deposit or even into a money market account and so on. So over time, the availability of these different options moves. Let me point out, and let me focus on the right side here in terms of a pass-through. So the dotted lines here are the US, the solid lines are the EU area. And even though the policy rate in Europe has gone up by less and more slowly, maybe it's interesting to note that time deposits in the EU area have gone up more steeply than in the US. And in terms of overnight, also marginally overnight in the EU area has moved up more. So if you like, in the EU area, more of the adjustment is between overnight and term, whereas in America, I think people go to money markets, and more of the adjustment is out of the banking system into the money market. Let me emphasize, going back to this recurrent point I have, which is the balance sheet reduction. Where is it showing up? It is in our surveys, both the QE, the monetary policy portfolio, and the TLTRO. Until the middle of last year, the banks were saying, this is basically helping us. You're creating so much liquidity, we're going to provide more credit. Now that has turned around. In the shrinkage phase, they're now reporting one reason why we're tightening credit is the loss of these highly liquid options to us. So in other words, you need to go beyond the policy interest rates and look at the balance sheet to understand the behavior of European banks. Let me compare what's going on now to previous cycles and what you see here, and we go beyond just the limited history of your area to also look in Bundesbank history. This is a fairly sharp tightening, much more rapid than before for good reason. And so we do have to think about what we learned from these more gradual episodes in the past, but I won't dwell on this point for now. But what we do see, which is striking, is there was very rapid adjustment in credit volumes in Europe. So credit volumes were running about 40 billion a month this time last year. They've been basically around zero since last autumn. So this is a sharp change in credit volumes. And on the right side, there's some comparison to previous tightening episodes. The dotted green line is what the models predict, like the VARs predict, if all that happened was policy rates went up. And the solid green line is what's actually happened, and it's a lot sharper. And again, the gap there can be maybe interpreted in terms of these balance sheet reductions. So let me compare again to the US. I mean, in terms of loan supply credit standard indices, I mean, there's obviously a tightening both sides, you see on the left. But maybe I'll emphasize on the right, the solid blue line is European credit volumes to corporates. The orange is credit volumes here in America. And you can see here a much sharper stop in the European data. So credit volumes have come down in America, but much more gradually and from a higher level, whereas in Europe, it came down much more sharply and has not recovered, even though the supply shocks hitting Europe last year are reversing. So we maintain this loan supply indicator to try and capture what's going on over and above the kind of interest rate channel. And it's moving up quite a bit. And in terms of loan supply going back again, you can link it to the balance sheet as well as to the rising funding costs. But maybe I'll emphasize is the history of loan supply shocks is it does reduce GDP. So what I have here is, if you like, the red line is the median. This is captured as if you have a loan supply shock that reduces credit by 1 percentage point of GDP, these calculations say that the median is that it reduces GDP by 30 basis points. But there's a wide dispersion here. This is a meta-analysis across many studies. You can generate much bigger drops in GDP. You can generate smaller. But if you like, what I'm saying is the median is a drop with uncertainty. What we're seeing so far is large corporates are less affected. Younger and smaller firms have seen a big turnaround in credit volumes. And again, going back to what Kristen said about the role of SMEs, especially in the European context, that's quite something. So I know I shouldn't overstep on time. So maybe I'll just finish by saying, so far we've seen a lot of movement in the financial sector because people move slowly in terms of their behavior. It's clear that we're only at the start of the impact of that on the real economy. Throughout the whole thing, I'm emphasizing there's an interaction with the macro developments, which have been relatively contained in Europe so far. But again, going towards risk factors, we have quite a good GDP forecast as the ECB. But if GDP doesn't grow in line with what we expect, then this banking channel will probably interact with that. And then going further, of course, all of this is in the context of essentially not much indication of significant stress. Whereas if we get an exogenous shock to stress that lasts more durably than the March shock, then of course we would have to think about that. So all of that put together saying we don't have a mechanical view of this. this episode is sufficiently unique. You can't just impose one set of calculations about how monetary policy works. And this is why we're very data dependent in calculating monetary policy in the upcoming meetings. And we will have some news before the next meeting. This bank lending survey will be published a day or two before the meeting. So let me stop there.
That gives us a lot to think about, and we'll download your paper from the ECB website also. Can you hear me? It's on? Okay, thank you. So let me go first back to Neel, who left a lot on the table from his fuller remarks that are available. There seems to be a lot of unanimity about keeping the eye in the US on inflation and using other tools to address bank stability. And I want to connect this to Philip's comments about the lending channel and the liquidity environment more generally. But Neel, you said we should rely on supervisors and existing authority to focus on banks and potential for insolvency, instability. So could you elaborate a little bit more on that?
Sure, thank you. You know, if you think about it from the perspective of a bank, what can a bank do today that is already facing large mark-to-market losses? The options are really limited. Number one, you could say, well, go try to raise equity. Well, if you look in the US, regional bank stocks on average have not recovered. So it's very difficult for a bank to raise equity in that context. Investors generally don't want to invest in funding somebody else's losses. And there's also the risk of a failed capital raise, which was the trigger for the SVB run in March. Number two, people talk about selling assets. Well, if you sell assets that are already lower marked, it doesn't do you any good unless somebody's willing to pay above market prices. So that's not really a realistic option. Third is to restrict your payouts. Many banks have already limited their share buybacks, so you're left with dividends. How many bank CEOs are going to willingly cut their own dividends? Very few, because for fear of hurting their own stock prices. So that just very quickly lays out banks are not likely to take action on their own. So what could supervisors do? One option would be to run a new stress test that is a specific high inflation, stagflationary scenario. Now, in a traditional stress test that we run, what ends up happening, high interest rates, as Kristen said, the traditional view is high interest rates are good for banks. So a high inflation, high interest rate environment is a positive shock. So that's typically not very interesting to stress, so to speak. So you'd have to run a dedicated stress test showing a stagflationary scenario, high inflation, high policy rates for an extended period of time, possibly leading over to credit losses on the real economy side as well, to really expose which banks are now exposed. Now, overall, as I mentioned, the US banking system is well capitalized. Overall, the US banking system is sound. I'm talking about exposing or identifying which are the individual regional banks that have a lot of exposure, and then using those results of the stress test, go to those individual banks and say, now you need to put together a plan to address this. Given the limited tools that the CEO has, that would then lead you to some type of dividend payout restriction to build capital. The advantage of something like this that I see it is it reminds me of the 2009 stress test. You know, the Federal Reserve did the stress test in 2009, went through this very complicated analysis, and then said, this is the assessment of where banks are. If banks take these steps, we have confidence they can endure this high inflation scenario. So in a sense, it'd be confidence. I think it would be confidence boosting because the regulators have said, supervisors have said, we think this plan works. And now if inflation then falls from here, as markets expect, and as we all hope, then this problem will largely go away. And banks could then return capital to their shareholders once we're through this inflationary episode. So I don't think we are incapable of addressing this. I do think it would take some very sharp supervisory actions to make sure that every bank was in a position to endure this.
Well, just quickly to cross-reference Neel on stress testing, for those of you who keep track, the European Banking Authority stress test of European banks essentially does this kind of stagflationary shock. Quite a big drop in GDP coming from a supply shock, quite a big increase in inflation and interest rates. And those results are coming out at the end of July. So you can see for yourself at that point.
I'll actually jump in there too. The Bank of England just released this morning a result of a stress test that was similar to what you announced. They hit interest rates going up to 6%, which probably seemed high when they did the test. Now they're getting pretty close. Their market expectations are 5.5%, but they hit unemployment more than doubling to 8.5%, inflation to 17%, and house prices falling by about a third. And then they ran exactly the scenario you did. Banks look like they were well capitalized for now, but I think that is a good example of what should be done more in the future.
So in the theme of thinking about if not working through policy rates, what other tools can be used? So supervision. Philip emphasized for the ECB the credit restrictions working through banks and through the lending channel. So for the US, what are the alternate tools that would work through the lending channel to change the liquidity environment? And we had talked about quantitative tightening, taking a different approach to the balance sheet. Are there options along the line for the US along the lines that Philip described were effective in Europe, recognizing the very different institutional environment?
I mean, I think it's certainly theoretically possible if you wanted to, you could change the balance sheet runoff in the US to try to have an effect on the long end of the yield curve. At the end of the day, a lot of the dynamics we've been talking about for banks is really about the shape of the yield curve. An inverted yield curve does not work for banks because their funding costs are higher than their lending costs. And if that's an inverted yield curve for an extended period of time, a lot more banks are going to feel a lot of pressures as a result of that. So ultimately, in terms of your outlook for the banking sector, you need to take some outlook for the yield curve and how long it's going to be inverted and how high rates are going to go. I, for one, would be loath to tweak our balance sheet runoff. I think our balance sheet is running off at a brisk pace, roughly twice the rate that we did in the last balance sheet runoff. It's been quite effective going on in the background. Financial institutions have been able to plan for it, have been able to adjust to it. For me, I think the bar would be quite high in tweaking our path for the balance sheet runoff.
Jump in. It's a tool I wish we could use, except unfortunately the US did not set it in place well enough in advance, is greater use of countercyclical capital buffers. The Bank of England has used the CCYB. Again, I think they could have used it more aggressively. Other countries have. The US has been slow to do that. And that would be an easy fix right now without having to get into changing balance sheet runoff or other issues of if there is more of a problem in the banking system without having to bank off what you're doing with interest rates.
I'm going to go back to Philip with one question about banking stability before we open it up so you can think of your questions. One of the additional, we've mostly focused on the regional banks in the US, but of course there was a big failure in Europe writ large, Credit Suisse being taken over by UBS. And Philip was quick to point out to me that that's a Swiss bank. So his responsibility and authority is limited there, but we did want to ask about spillovers for the rest of Europe.
Yes, so I'm sure the Swiss people in the room will agree with me. Switzerland is not part of the EU. And what I said, obviously, with this case, this was a kind of essentially a global bank. It was not something that the problems were not emerging from the European situation. It had its kind of business model issues, if you like. But the potential spillover was essentially the decision, if you like, to kind of surprisingly write down the value of AT1 bonds using kind of supervisory discretion. And since this was not expected, even though it was in the documentation, there was a risk there could be a spillover to the AT1 market, where a lot of contingent capital is raised by European banks. But the supervisory authorities in Europe were pretty quick to come out and say that what happened in Switzerland was possible under Swiss law. It's not something that's envisaged under European Union law. And that market has been reopening, and it remains an open question of whether it was basically a temporary episode in terms of spillover, or whether there may be some longer term footprint. But right now, because the market is reopening, I wouldn't say the worst case scenario is developing.
I have a long list of questions, but I'm going to keep them on the paper for now. looks like I won't get a chance to ask them. So let's start with Shebnam.
Thank you very much. Very insightful comments. I would like to ask all the panelists on the role of heterogeneity in the US, UK, and Europe. We know that when the initial data came out in the US, when the banking failure started, such as Beige Book, H8, and all that, we saw a credit supply contraction from the mid-sized bank. But now the regulatory supervisory data from the stress testing came out in May, and we see that large banks are not cutting lending at all. And of course, we know even the situation with Bank of America, they have a way more diversified balance sheet. And we also know that SMEs, which are more than 50%, almost 60% of the employment in the United States, do borrow from the large banks. So at this juncture, given that nothing going on in the large banks, SMEs, who we are worried about, do borrow from large banks, how much the emphasis should be put on exactly supervision and regulation to strengthen the system as opposed to slowing down the pace of the interest rate hikes to control inflation. Thank you.
Maybe we can just have one or two people answer each question so that we can get more voices in.
Very quickly, I think you're right. I think it is a lot of heterogeneity across the U.S. The small and mid-sized banks that I speak with talk about one of their concerns that they have right now is that they feel like they're deposit constrained. So they're being very selective on where they're deploying their limited deposits to their best customers. But you're right, the biggest banks generally have a lot more liquidity. And so that's why I agree with you in the near term, it is much more on a bank by bank case that we need to take action. Having said that, I've argued for years that higher capitalization across the banks in the US would better position us in the future from facing these types of scenarios. And so, for example, the vice chair of the Federal Reserve Board, Michael Barr, recently gave remarks, I think yesterday, saying that he thinks we should raise capital for the largest banks by around 2% of risk-weighted assets. That would be a step in the right direction, and that would position us better in the future.
Just to add the point that was brought up earlier about net interest margin, has very heterogeneous incidence, right? Because the deposits didn't flow out of the GSIBs, deposits flew into the GSIBs. Okay, let me go to Marcus Brunemeyer.
You have a quick question for Philip about the separation principle. So typically you want to keep price stability and financial stability separately. And I was wondering, recently the ECB has decided under SSM to allow UniCredit to make a huge bonus payments and also huge dividend and stock repurchases. And I was wondering whether you think the Chinese wall between SSM for bank supervision and the monetary policy should be such a big Chinese wall, given that this might actually create problems down the road. So it would be good if UniCredit had more capital at hand if something were to happen. And if you look at Kristen's slides, there are huge hidden losses in the Italian banking system. And even if UniCredit might not be in trouble, it might be useful to have a strong bank there to take over some smaller banks in Italy.
Okay, so again, I'm very much not going to comment on any individual bank, as you can imagine. But what I would say is, in the last 10 years, now we have this supervision across Europe led by the ECB. Let me contrast or do the counterfactual. What would Europe look like if we still had national supervisors making these decisions at a national level, not internalizing the value of having basically a common supervisory approach across the area? So compared to that, having what we have now, which is a very centralized single supervisory mechanism, where there's tons of interaction in terms of understanding what's going on macro-wise, banking-wise. But for decision-making, I will fully defer to the supervisory board, who, in terms of the pros and weighing up the pros and cons of any of these decisions. So I don't think there's any problem here in terms of how the supervisory decisions are made. And I think if you read the speeches of Andrea and everything, I mean, they're very, I think, fully informed. And in the end, I mean, rather than kind of reviewing or critiquing any individual decision, which is going back to what Neel said, I mean, and what I have quite a bit in the longer text today is we can do monetary policy much more smoothly, knowing that the banks have a high degree of capital, have a high degree of liquidity. It just makes life so much easier compared to maybe some previous episodes where it was clear that kind of the weak state of the banking system was making decision-making more complicated. Decision-making now is a lot easier when we do know. Now, we always care about tail risk and we care about it, but when basically the banks are adjusting, they need to adjust, but we want them to adjust in a smooth way, not in a kind of tail scenario way.
Thanks. I think that was quite interesting when Kirsten said banks benefit from high rates, but why would worry now with high rates? When banks have a lot of bonds in their assets, it's quite the impact on the balance sheets are quite big. But I cannot resist to make a comment that it seems that the world is upside down. We had this discussion in emerging markets 20 years ago, how much you can raise rates without affecting financial stability. Now, Brazil, Chile, and Mexico have gone up with rates from 2-3% to 11-14%, that this is not an issue. And I think that the solution has been financial regulation. So you don't take care about financial stability with monetary policy, you do it with financial regulation.
The division of labor is working.
Okay, Dick Berner.
Thanks for the great panel. If I may, two questions. First, Kristen, you made the important distinction between using asset purchases for market functioning versus using them for monetary policy purposes. Now, in the Bank of England, your former institution, that distinction is made very clear as illustrated by the LDI incident. How would you advise the Fed to make that distinction clearer for the future? The second question is, do you think, any of you on the panel think that we need to address issues related to our resolution regime to make it more credible, to provide the right incentives for banks when they think about their potential failure?
Start with LDI and leave resolution to the two of you. So for those of you who didn't follow details in the UK as closely, we was referring to in the fall of last year when there was a mini budget announced in the UK, yields spiked. So it was not because there was big surprises in what the Bank of England is doing, but it was more surprises about the solvency of the government that led to a spike in yield curves, questions about a new budget, and then pressure because of this sudden increase in yield curve meant that pension funds were suddenly under a lot of stress. And it was a small segment of the pension funds related to LDIs and a hedging strategy, which was not hedged against a sudden spike in interest rates. Again, there was an irony similar to what we see for banks, where pensions in general do better with higher interest rates. So if time had been able to pass and there hadn't been forced selling of these bonds, which had suffered temporary losses, then the pensions funds might have been okay. It was the combination of the spike in yields, putting margin calls, forcing them to sell. So it's really more of a liquidity issue and not clear it was a long-term solvency issue. So there, what made sense, the Bank of England stepped in and did do a short-term limited asset purchase program targeting the assets were subject to this forced selling. It was a bit of a gamble by the governor of the Bank of England to say, I'm only going to do this much, this amount of time, take it or leave it, and then I'm done. Some people weren't sure if that would be enough to stabilize markets. People weren't sure if things hadn't stabilized, if he really would end the program. But it was finally deemed as credible, and some of the institutions that were in trouble did take advantage of the short-term purchase program. And then tensions eased, also helped though by the fact that then there was a change of government, new government came in, addressed some of the concerns about budget sustainability. So combination of factors. But I think the lesson from that was when at the same time inflation was picking up, Bank of England had to keep raising interest rates and wanted to keep selling assets and reducing the size of its balance sheet. So you could see a communication challenge, raising interest rates, reducing the size of your balance sheets, and starting a new asset purchase program at the same time. But they did, I think, manage it quite well. I think this is a model that other countries should look at if these sorts of situations arise in the future, where you could have a very specific asset purchase program targeting a very specific financial market issue that is limited, ended. And then what also is different than traditional asset purchase programs is the Bank of England didn't buy these assets, put it on the balance sheet and sort of hold it for a long time and only let it fade off very slowly and gradually over the years. They were very clear, we're going to buy it short term, sell these assets. And they did. They actually have already unwound the assets they bought in the fall and made a nice profit on it. So again, I think that's a nice example of where I hope central banks go in the future is just more clarity. When you do asset purchase programs, it's not just a big program meant to accomplish everything, either aimed at price stability, supporting growth and stability, price stability, which then could be longer term holdings that wind up gradually, as the US and ECB is doing now, and then more targeted specific short-term programs. Sometimes the distinction is hard, like March of 2020, it would have been hard to differentiate. But going forward, hoping we avoid another period of stress like March of 2020, I think more likely risks are going to be where they're just limited financial stability issues. You could do those sorts of limited asset purchase programs. A resolution?
Where Neel has agreed to be buttonholed after to answer your resolution question, because I have a couple more people who had their hands up for quite a while. So we have 2 questions in 0 minutes. So I'm going to, you'll scale appropriately. No. Okay.
I understand that the dogma in our profession has been to combat inflation with aggressive interest rate hikes for decades. But I'm wondering whether we should change the emphasis to more aggressive reductions in balance sheet central banks. And I say this because this seems to be natural for.
Oh, you need a mic.
So I'm wondering whether we should change the emphasis to more aggressive balance sheet policies and less aggressive interest rate hikes. And I say this for the following 2 reasons. So one principle of policy making should be that, you know, if we have an undesirable outcome from a particular policy, that we should, you know, undo that undesirable outcome with the same tool. So if you're willing to contend that in part, the large balance sheet expansions are in part responsible for the inflation that we have now, you know, a natural principle is let's undo the balance sheet expansion rather than raising hikes, interest rate hike, and then combating the following problem with more regulation. And the second idea is that reducing balance sheet policies may be the best way in which you could combat inflation in the most resilient way, in the sense that if you combat inflation with interest rate hikes, you're exposing some agents to interest rate risk. Whereas if you undo the balance sheet, it will be the agent who's more capable of buying the treasuries or whatever assets.
So it's a very interesting question. So let me explain how we do it at ECB, because of course, every central bank operates in a legal framework, but we definitely operate in a legal framework because our decisions can and have been challenged in the European Court of Justice. So what we do with our monetary policy decisions is we say, okay, how can we do this? And we have a kind of checklist of efficiency, effectiveness, proportionality about the role of interest rates versus the balance sheet. And we also went through this in our strategy review a couple of years ago. And I think we remain convinced that there is a hierarchy. So basically, when you get to the lower bound and you can't use interest rates anymore, you do have to switch to a mix of forward guidance and then balance sheet policies. But in the other direction, it's not true. I mean, the most effective thing you can do is raise the policy rate. And again, going back to what I said earlier about 2019, I mean, a couple of years ago, there's many concerns. How are we going to get out of QE? And the answer is, if you raise the policy rate enough, people will be perfectly happy to buy European bonds. You can shrink the balance sheet once the policy rate goes up enough. So I think you've created, I think, maybe a false proposition there, but by kind of contrast, you have to think about it jointly. That the role of the balance sheet is conditional on where the interest rate is. When the interest rate is more or less at the zero lower band or the negative lower band for us, you move to the balance sheet. But right now, we do report the balance sheet is playing a role, but it's conditional on where the policy rate is. What I have emphasized, I do think the liquidity side of the situation, the implications for central bank reserves, and that for banking policy is maybe underappreciated. There are people in this room who've been emphasizing it, but the impact in the yield curve, going back to Neel, I mean, if we just did a balance sheet reduction, it may put up term premium to some extent, but that is so minor compared to the just raising the policy rate. It is a secondary tool, but.
Can we just get the last quick question in? Thank you.
Yeah, thanks very much. I was going to say, I think everybody knows that monetary and financial stability objectives have come into the conflict in the past, and they will come into conflict in the future. I think that's absolutely clear. But there's a lot of uncertainty out there with respect to how that conflict is going to be addressed by all the different central banks around the world. And we heard from Draghi yesterday saying that the ECB has been very explicit about how they will deal with fragmentation risk with a change in their policy reaction function. And I really think that for central banks, there's a clear case to be much more transparent about how that conflict. So appreciate any comments on that. Thank you.
Just, I appreciate the spirit of what you're saying. The experience that we've had in the US in the last few months is very interesting. I mean, this notion of depositors getting spooked in Silicon Valley Bank because they had a failed equity raise. And then you saw bank regulators seized banks. They wiped out the equity. They guaranteed the depositors. Then you had this dynamic of depositors and other banks getting scared. Even though the depositors had been made whole in those banks, they were scared by the stock prices getting crushed in those other banks. So it's a very unique situation of an intersection between stock prices and depositors and bank balance sheets. And so the only reason I say this is it's very hard to forecast all of these different scenarios and what the central bank's reaction function is going to be given these different scenarios. And so I think given that, my best advice would be making sure that the banking system overall has as much strength and resilience overall, so we don't find ourselves in these positions in the future.
Thank everyone for their questions and the panelists for their remarks. We'll take a break.